Let's work through lecture example 1.1. In this example, you've been told that Draper Limited maintains a constant dividend payout ratio. So they are paying out the same percentage of earnings as a dividend each year. The following information is available. You've been given their earnings and also the dividend for the 20x4, 20x5, 20x6, 20x7, and also the 20x8 year. First, you need to calculate the dividend payout ratio and also the dividend cover. So guys, if you look at the calculation just below, how do we calculate the payout ratio? We take the dividend and we divide by earnings. So if you use the information for the 20x4 year, take the dividend, divide by the earnings, you'll see that the company has a payout ratio of 20%. So this company maintains a constant dividend payout ratio of 20%. Every year they pay out 20% of their earnings as a dividend. Now please note, because they have a constant payout ratio, you could have performed this calculation using any of the years. I performed the calculation using 20x4. However, you could have also performed the calculation using 20x7 and you will get exactly the same answer because they have a constant payout ratio. So you can see that discussion just below. Because they maintain a constant dividend payout ratio, you will get the same answer regardless of which year you use in your calculation. All right, so we calculated the dividend payout ratio. We now need to calculate the dividend cover. So remember, the dividend cover is just the inverse of the payout ratio. So now we take the earnings and we divide by the dividend. Once again, you can use any of the years in your calculation and you will get exactly the same answer. We get an answer of 5 times. So what does that mean? Earnings cover dividends 5 times. Please note, guys, the payout ratio and the cover ratio are just the inverse of each other. So we can calculate the payout ratio by saying 1 divided by 5, or we can calculate the cover ratio by saying 1 divided by 20%. Then one other principle that's extremely important. If the company has a constant payout ratio or a constant dividend cover, then the growth in dividends will match the growth in earnings. So you'll see above in this example, both dividends and earnings are growing at a rate of 10% per annum. You can see that above. Earnings are growing by 10% per annum, and because the company is constantly paying out 20% of their earnings as a dividend, the dividend is also growing by 10% per annum. So where the company has a constant dividend payout ratio or a constant dividend cover, the growth in earnings and the growth in dividends will be exactly the same. All right, so in part 1, we had to calculate the payout ratio and the dividend cover. In part 2, you now need to discuss the advantages and disadvantages of the dividend policy adopted by Draper Limited. So let's first discuss the advantages. The first advantage is dividends will track the performance of the company. If earnings increase, dividends will increase. If earnings decrease, dividends will decrease. Because the dividend is always a fixed percentage of earnings, there is a fixed relationship between earnings and dividends. And because of that, shareholders will know what to expect. So you don't have to, the company won't have to justify why they are paying a certain dividend. The shareholders will know. Every year, 20% of earnings are paid out as a dividend. It is a constant percentage of earnings. Then a payout ratio of 20% is also very conservative and it promotes business sustainability. Only 20% of earnings are paid out, meaning that 80%, the bulk of earnings, are retained in the company for future use. Then what are the disadvantages of a constant dividend payout ratio or a constant dividend cover? First, the dividend will lack stability as it is going to fluctuate with earnings. So if earnings increase, the dividend increases. If earnings decrease, the dividend decreases. Now don't get confused. We said above that this is an advantage because dividends will track the performance of the company. So when the company performs well and earnings increase, the dividend will increase. If the company performs badly and earnings decrease, the dividend will decrease. So it can be seen as an advantage because the dividends will track the performance of the company. On the other hand, it is also a disadvantage because dividends will fluctuate with earnings. And fluctuations in dividends from one period to the next may adversely affect the share price due to the information content or signaling effect. So if the company has a bad year and earnings drop and they are paying 20% of their earnings out as a dividend, that means the dividend will also drop. And remember, what does that signal to the market? If dividends drop all of a sudden, that signals that the company is not performing well. There's a question as to the future growth prospects of the company, and that could cause the share price to drop. So guys, just be careful. There are both advantages and disadvantages associated to that. The same logic actually applies with the next point. We said under advantages, by paying out only 20% of their earnings as a dividend, 80% is retained in the company. So they have a conservative policy. They are keeping the bulk of the earnings in the company for future use. However, they do this every year without even considering if there are any profitable investments. Every year they just go, this is the earnings figure, 20% will be paid out as a dividend. There might be a year where the company actually shouldn't be paying any dividends because there are so many profitable investments, it would be better for them to rather invest and keep the money in the company. By having a constant payout ratio or a constant cover, they don't even consider this. Every year they just always pay out the same percentage. So although the dividend policy is conservative and that is an advantage, the disadvantage is the financing of profitable capital investments is not considered. All right, perhaps in 1 year, keeping 20% of the earnings in the company is not enough. Perhaps over the next 5 years, the company might have significant capital expenditure and they might need to actually hold back more. Or perhaps they're actually holding back too much and they don't have any investments this year, so they should be actually paying out a higher dividend. The point of this disadvantage over here is the fact that they don't even consider this. They don't consider profitable investments. Straight away, every year, they always just pay out 20% of earnings as a dividend. So the problem with this is profitable investments may be rejected in favor of dividend payments. So if there's not enough money for both, then the company won't invest. They'll rather just pay out that 20% dividend. Then in addition to that, if sufficient equity is not retained in the business for investment purposes, then new shares will need to be issued in the future when equity finance is required. And we know if new shares are issued, that will cause a dilution in control. The market value per share will drop. Other key indicators will also drop, such as earnings per share, dividends per share, etc. Then, another disadvantage of having a constant payout ratio is the availability of cash to honor the dividend payment is not considered at all. Every year they just pay out 20% of the earnings as a dividend, and they don't look at whether there's enough cash in the business to actually pay that dividend. Now guys, remember there's a difference between profits and cash. You could have a situation where a company is profitable, but they don't actually have sufficient cash available for the dividend payment. So we don't just look at, is there enough retained earnings to make a dividend payment? Obviously, you need to have enough cash in the bank to make that payment. Another disadvantage, guys, is shareholder preference. When it comes to dividends versus capital growth is completely ignored. They don't consider shareholder preference. Every year, they just pay out 20% of their earnings as a dividend. And lastly, actually very similar to the last point also, is what similar companies in the industry are doing, or industry norms, are also completely ignored. Every year they just pay out 20% of their earnings as a dividend without considering if there's any investments they need to maybe be making, without considering if there's cash available, without taking shareholder preference into account, and also without taking into account industry norms. What are other companies in the same industry doing? What do their dividend payout ratios look like? You should also always consider what competitors are doing. All right, so that deals with example 1.1. Please jump to example 1.7. Olsen Limited paid the following dividends over the past 3 years. So you've been given the dividend for 20x4, 20x5, and 20x6, and you can see the dividend is increasing each year slightly. It was 100 cents per share, it's then 105 cents per share, and then 110 cents per share. Profit increased by 10% in the 20x7 financial year. The company has significant investment opportunities and has decided to reconsider their current dividend policy. You need to discuss the potential reaction of the shareholders if the company decides not to declare a dividend in the 20x7 financial year. So how will shareholders react if the company has been paying dividends for the past 3 years, the dividend has been increasing slightly over those 3 years, in the current year profits grew by 10%, and now all of a sudden the company is not going to pay a dividend? Now the first thing you always need to discuss, guys, is shareholder preference. Different shareholders have different preferences, meaning they will react differently to this decision. Certain shareholders will be happy with this decision. They will favor not receiving a dividend because they prefer capital growth in the share price as a result of capital investments. So we saw the reason why they want to change their dividend policy is because they have significant investment opportunities. So they rather want to use the money for those investment opportunities. So shareholders, some shareholders will be happy with this decision, and those shareholders will be the ones that prefer growth in their share price. So you can see these shareholders would be happy with the decision to fund investment opportunities with cash reserves instead of paying dividends. On the other hand, other shareholders may prefer a dividend rather than capital appreciation, and these shareholders would not be happy with the decision. All right, so first discuss shareholder preference. Some will be happy with the decision. Those that prefer capital growth in the share price, they'll be happy with the decision. However, those that are dependent on the dividend each year and those that are risk averse, they would rather get the known dividend today than wait for uncertain capital growth, they would not be happy with the decision. Now, another problem is the company's actually created an expectation for an increased dividend in the 20x7 year. What has created this expectation? First, the company has been paying regular dividends over the past 3 years, and the dividend has been increasing over the past 3 years. In addition to that, the profit in the current year grew by 10%. So if profits are growing, then the dividend should also grow. Because remember, what do shareholders believe? That any growth in earnings should be validated by way of a dividend. All right, so we saw that in our lecture. So you can see that just below. There is an expectation for a dividend because over the past 3 years, dividends have consistently increased by 5 cents per share. And in addition to that, profits in the 20x7 financial year increased by 10%. So shareholders might be expecting a dividend. So according to the information content or the signaling effect, the shareholders might view the lack of dividend as an indication that the company is experiencing difficulties. So remember, guys, how does the signaling effect work? We have a company here that has been paying dividends for the past 3 years. Every year the dividend has been consistently increasing. In the current year, profits have increased by 10%. So there's definitely an expectation for a dividend. If the dividend is all of a sudden cut, so at the AGM, the company or the directors say to all of the shareholders, we are not paying a dividend this year. According to the signaling effect, that can be seen as the directors imparting negative news about the future prospects of the company. So the shareholders might read that as the company is experiencing difficulties. That might result in them selling their shares. And if there's an oversupply of shares, so if the shareholders are all selling their shares because they're worried about the future of the company, nobody's going to want to buy those shares because everybody's worried about the future of the company. That could then cause a decline in the share price. So they need to be very careful. If it's a company that has consistently always been paying dividends in the past and they just cut that dividend, it could be seen as imparting negative news about the future of the company. Shareholders might want to sell their shares, and if there's an oversupply of shares in the market that no one wants, it could cause the share price to drop. Then in the next example, Campbell Limited has a policy of not paying dividends. Instead, earnings are reinvested for expansion purposes and other projects. You need to discuss the impact on their share price. Now guys, your discussion over here can't be the same as the discussion in the previous example. In the previous example, we had a company that created an expectation for a dividend because they had been paying dividends in the past. Over the last 3 years, they paid a dividend that was increasing slightly each year. So they created an expectation for a dividend. On the other hand, in this example, we have a company that has a policy of not paying dividends. So they haven't created an expectation of a dividend, they have never paid dividends. So your discussion here is slightly different. First, you should always still discuss the signaling effect. So you'll see in all of our discussions, we always look at the signaling effect, and we also always look at the clientele effect or shareholder preference. Those things should always be discussed. So first, if we look at the signaling effect, we know that if dividends are not paid, this might have a negative impact on the share price of the company. And the reason for this is because many investors believe that the company's earnings and growth potential for the future should be validated by way of dividends. So in other words, if the company is performing well and if they have significant earnings, if the directors believe that the future growth potential is very good, then surely the company should pay a dividend. If there's money available, surely you would pay a dividend. So that's what some investors believe, that if the company is not paying a dividend, then it could be that the company doesn't have earnings available for the dividend. It could be that the directors feel negative about the growth potential of the company, and that could then obviously have a negative impact on the share price. So that's the signaling effect. However, we also always need to consider shareholder preference and the clientele effect. Now we know, according to the clientele effect, a company should have a dividend policy that is appropriate for its activities. So all companies are unique, all of them have different activities, meaning all of them should have different dividend policies that are appropriate for their activities. So they have that policy. Now, if we apply it to this question, we were told that Campbell Limited has a policy of not paying dividends because instead earnings are reinvested for expansion purposes as well as other projects. So if we discuss this in more detail, Campbell Limited believes that by reinvesting their earnings for expansion purposes and other projects, their share price will appreciate, which will ultimately lead to a greater return for investors. So what Campbell Limited has done is they have looked at their activities and they've decided on a dividend policy that is suitable for their activities. They've decided that they can't pay dividends, all of the money must be kept in the company for investment purposes. And their view is they will then use that money in order to invest in profitable investments, which will increase the value of the company. And if the value of the company increases, the share price will go up. So eventually when these shareholders sell their shares, they will then benefit from the capital gain on the sale of their shares. So according to the clientele effect, investors will then choose investments that have a dividend policy that meets their particular requirement. So obviously, guys, if you are a rational investor, look at yourself now. If you now want to go and buy shares, you obviously don't just buy shares in any company. You do a bit of research up front first. If you need a dividend every year, if you are dependent on that dividend every year, you are obviously going to make sure that you buy shares in a company that pays regular dividends. On the other hand, if you are a high income earner, you are not dependent on the dividend, you are rather interested in growth in the share price, you would then invest in a company that doesn't necessarily pay dividends, but they rather reinvest the money and they focus on growing the value of the company so that one day when you sell your shares, you'll make a gain on the sale of your shares. So the whole point behind the clientele effect is, First, the company picks a dividend policy that's appropriate for their activities, and after they've done that, investors will then choose investments that have a dividend policy that meets their particular requirements. So what type of investors would invest in Campbell Pty Limited? High-income investors are likely to prefer companies that do not pay dividends, as they are not reliant or dependent on the dividend. Investors who are in pursuit of high-growth shares, so in other words, investors who want to make a capital gain on the sale of their shares. They will not be concerned with dividends, and they would prefer that the company rather reinvests the money so that one day they can make a gain when they actually sell their shares. So they would prefer investing in a non-dividend paying company like Campbell Limited. These types of investors do not expect dividends, and their only return on investment will be in the form of capital appreciation. All right, hopefully, because remember, that's always uncertain. These investors are often risk takers, so that's linked to that. Because capital appreciation is uncertain, these investors are often risk takers, and they are looking for a higher uncertain return. So because they take higher risk, they are interested in higher yet uncertain returns. All right, guys, that is then everything that you need to know for the dividend decision. Please make sure that you work through the rest of the lecture examples on your own.